The big news of the day is the GDP, and joining us now with his analysis of the U.S. economy is Markus Schomer. He's the chief economist at Pinebridge Investments. Markus, thanks again for joining us today.
Thanks, Michelle.
So what do you make of the revision of the GDP data down from 2.5 to 2.4?
It was a good number.
Why? How is that a good number?
Well, because the way I look at this is we have a two-speed economy right now. The headline number did go down from 2.5 to 2.4, as you highlighted. But if you look at private sector growth, which is consumption, the housing market, and business investment, that was revised up from 3.4 to 3.5%. And over the last 2 years, the private sector has grown at an average of 3% per quarter. That's a very strong number. If that had been the headline, I think we would have a very different market environment. What's holding us back right now is fiscal austerity. But I believe the government has packed a lot of the sequester and the budget cuts into Q4 and Q1, the last 2 quarters.
Right.
And we will see that headwind fade over the next couple of quarters.
So you say when we dig deeper into the data, it's actually not really such bad news. Now you mentioned the sequester, and government spending saw its biggest 6 months contraction since the end of the Korean War. So
Yes.
That's a considerable amount of time. How much of a challenge is that going to be going forward? Or you think most of that's already been budgeted into the last 2 quarters?
Yes, exactly. I mean, you highlight how much government spending has been cut the last 6 months, and that's, I think, way too much than what people had expected for the full year. So I expect government spending to be falling at a much slower pace going forward, and it may even be increasing again in the second half of this year, adding to a fairly robust growth trend in the private sector. So I think by the end of the year, we will see 3% growth rates in GDP.
3%?
Yes.
So what will drive all of this growth? I mean, that's a pretty high estimate.
Well, 3 things. The housing market.
Right.
You did highlight pending home sales are a little bit weaker, but they are at multi-year highs.
Well, at a 3-year high, yeah.
Right. The consumer is doing reasonably well. Consumer confidence, for example, is at the highest level since the recession. And lastly, business investment. That's where I really expect the biggest bang in the second half of the year. Right now, the surveys don't show it yet, but I expect bottlenecks in the business sector, such as capacity utilization, for example, or the amount of hours people are now forced to work. That will incentivize businesses to invest more and hire more, and we will see that in the second half of this year, and that will drive growth up to 3%.
You think businesses have enough confidence to pick up hiring?
Right now, admittedly, if you look at the surveys would suggest no. But I look at the bottlenecks that are developing right now and have been developing for the last couple of months, and I think that will continue over the summer. And if we see less drag from the government sector, overall demand will increase, and these bottlenecks will drive businesses into more investing, into more hiring. And the profit numbers are still looking good enough for businesses to do that.
Because whilst the housing recovery has gained some momentum, the employment front still a little shaky. So if what you're saying will pan out, the employment picture should get a little brighter.
It should get brighter, yes.
Which brings us back to the Fed and
Yes.
the big topic of the day. Everybody's speculating, when will the Fed begin to wind down its massive stimulus program? So if you're saying that the data is more positive than it appears and that GDP will be revised higher, will actually be higher in the future, surely that means that we should start expecting the Fed to taper things off. What are your thoughts?
Well, I don't think that my forecast would surprise the Fed. I think that's very much the way they see the GDP growth developing this year as well. I don't think being at 3% at the end of the year would be a surprise for most of the Fed members. But listen to what Ben Bernanke says. He describes the current environment as moderate growth, unemployment well above average, and inflation subdued. Here you have your 3 measures. So the economy needs to pick up. It needs to be more than moderate. The unemployment rate needs to come down quite a bit more.
Well, the Fed has said 6.5% is their target.
That's for interest rates. That's when they start looking at interest rates. They will taper well before that. But I think unemployment not well above averages means somewhere close to 7% or below 7. 6.5 is just for interest rates, but I think 7% could be the threshold for tapering, and we're not there yet.
So when do you think we can start to see that kind of tapering, and what will that mean for the markets?
I think that's a very difficult call because most of us who look at the Fed every day don't have much to go on because we are in uncharted territory. But I don't think we will see it before the end of the year. I think once we have more confirmation that the economy really is growing at 3%, I think that's when the Fed will start looking at the way they will reduce the asset purchases, not before the end of the year, though.
So the markets will be able to maintain that rally then?
Well, I think the markets will be volatile. It will be roiled every time, as you highlighted in your opening remarks, every time we believe the economy is stronger and the Fed may taper, you'll see the stock market react, and it will be quite volatile. I think there is more upside this year for the market, but it will be more volatile than what we've seen over the last 6 months.
Okay, we're going to have to leave it there. Thank you so much.
Thanks.
Markus Schomer, Chief Economist at Pinebridge Investments.